Good morning, ladies and gentlemen. This is Clueless 8. This is October 7th, 2015. And here is the pre-market AM report. Following up from yesterday's midday update on the markets and a somewhat frustrating and at times confusing situation, which at this point, as we can clearly see on the pre-market futures, has resolved itself for the time being. So let me just explain to you what I just said. In simplest terms, if you follow up from yesterday's midday report, which I took time to do so people can understand what was going on with the markets and overall, it was a mixed day. However, this particular pattern that I put as a consolidation channel bull flag, I said a possible consolidation channel bull flag. Remember, I repeat, there are a lot of mixed messages in the market based on the internals, but the general propensity of the market and the directional bias from what it looks like at this point is higher, at least till Friday. Period. Now that fits in with my thesis that the first 5 to 7 business days of the month are when the new money flows come into the market by large institutional and pension funds, money managers, and obviously they are piling into the depressed energy arena. They are also piling into select sectors as well as on the tech side. They are coming out of from a good portion of the biotech stocks, which in itself is landing some opportunities. One of our favorite long-term holds and buys, Juno Therapeutics, was up about 10% yesterday. So just to give you an idea of what how this pattern is playing out. So let me get my drawing tool, and this is obviously the possibilities, and I repeat, the adaptability and the flexibility that all traders and investors need to have in the market. It does not matter what we think. In many cases, what we see directly in front of us, the market will resolve itself based on where it wants to go. There's an old saying in the business that the markets will reach its predestined direction, target, or predetermined price, higher or lower, regardless of the noise that's out there. And in reality, that's exactly what happens. There's a lot of technical factors why that type of stuff happens. The simplest way to look at it, that a significant portion of institutional managers, institutional traders, retail traders are either bearish, short, or neutral. In other words, sitting in cash. There's a huge pile of cash on the side. A fourth quarter is going to turn out to be slightly better than what it looks like, or no, what the consensus is, which is almost a negative 5% in earnings expectations. That's one of the lowest earnings expectations going into any quarter in the last 14 years. That a semblance of any slight good news by any type of company, especially the larger ones, will drive this market up higher, back towards the old highs. Saying all that, this consolidation bull flag pattern now is broken out. So at this point in time, the SPYs are trading up here somewhere, up towards the upper end of the channel. We are up about 12 S&P points. 12 S&P points, that brings us up to 1980 on the S&P. That's roughly about 1985 or 1986 on the SPX. So in other words, we are right now, this bull flag has resolved itself to the upside, normally what bull flags do. Now keep in mind that there are different counts here. First, by the way, that extension could lead to the upper Bollinger, which I've said is somewhere around the 2000 mark. So 2000 could be a magnet that we are attempting to reach by tomorrow. Now, keep in mind there's a gap here, and this gap will get filled. The chances of the gap getting filled today are obviously being minimized because of the large pull up or gap open on the markets. However, markets can reverse itself and fill this gap, but that would be quite a large drop from 1980 down towards the 1950 level in order to fill the gap. So maybe they leave it for next week or towards the middle of the month when we get the real turbulence. Now, looking at the channel play here, this would be the way the market probably moves higher, okay, in between the channel, and reaches at least the first level of major resistance, which is around 202, 203 on the SPYs, which was also the breakdown level and the retest of the downtrend line from the highs of the market, and this was back on in the middle of September, okay? So let me clear these lines out here. So let me keep this simple, because that's what the essence of success is: simplicity. Honestly, taking difficult concepts, difficult ideas, processing them, and then acting on it in a very simple manner. That's my motto of life. It doesn't mean you have to be that simple that you don't understand all the complex motions that markets and life goes through. It simply means try to keep it simple when it comes to the execution of the acting part. So saying all that, bull flag has now resolved itself to the upside. We're going to hit the upper end of the channel, probably vacillate a little bit. We'll see what the action is there, and I have a feeling that they want to take this market up towards this level, if not here, which would be huge actually by tomorrow. MBA mortgage numbers came out and they were huge. Mortgage applications were up 25.5% versus minus 6 or 7% from last week. That's obviously a huge bump, and that's a big positive for the U.S. economy. Gaps here to be filled. This gap has already been filled. As you can see, this gap has already been filled here, so that's the gap remaining to be filled. In the meantime, we do have a negative divergence in play, as you can see here on the stochastics. That will probably right now be up like this when the market opens. Okay, period. The vortex indicator will probably turn up like this now, and the negative vortex indicator, the red one, will go like this. So stuff like this does happen, similar to what happened here, I believe. So let me get all these lines out again. So this is very clear to read, and when I put it up there, read it just the way I explained it, and put it up and match it with the midday update that I have from yesterday. Now let's take a look at the E-minis and some channels. This is a very precise chart that I drew last week, and this is a very mathematical type of chart. Very simple channels that I drew, okay, based on what I see. So at this point in time, we have this line here, this highlighted line, orangish line, is is basically your 34-day moving average. That's let me see here, make sure I'm talking the right thing here. Where was the crossover? Yes, that's a 34-day moving average that's keeping up everything. This is a 4-hour chart, and as you can see, it's trending higher. I'm sorry, that's the 5-day moving average. This one, I got to change the color on this one so I don't match it up with this line. This is the 34-day moving average. My fault. Because the standard deviation from the 34 and the 50, and by the way, I repeat, and I showed this yesterday in the other chart, that this is where the crossover happened. This was Tuesday at 5 in the morning. This is the E-minis, all right? Because remember, a significant amount of action is taking place pre-market, after hours, all right? So the bottom line is that the crossover happened on Tuesday at around 5 a.m., and that's the 34 crossing over the 50. That's definitively a positive. So when you have a breadth thrust of this magnitude, reversal, obviously the force and the momentum, pure laws of physics, carries the market well higher and causes a divergence, or it moves away quite a bit. Simple. Okay, standard deviation of probably 3 or 4, probably 3 from the moving averages. So at one point, the markets will have to pull back a little bit, or the moving averages have to push up quite a bit more to narrow this gap. In other words, that's called mean reversion. Bottom line, let's look at this chart here. Upper end of the channel is 1999 on the E-minis, all right? The E-minis right now are at 1980, at 1980.25 right now. So right now, we are basically not even at 1990, we are here. So we are on the upper end of the Darvas. Another thing that you notice, and these are observations that I noticed very, very carefully, is look at the size of this Darvas. This is a bottleneck. This is a serious bottleneck. Look at this. There's the Darvas box. Being drawn in blue here. I don't know why. Okay, there's the Darvas box. It's extremely narrow. It's a bottleneck. It looks likely that this bottleneck will be resolved to the upside. Okay, let me change the color of this pen here. Pen color. Okay, better. So this is the Darvas box here. See the candle right there? This is pre-market live, what we're seeing. So the resolution could be up towards this 1999-2000 level on the E-mini. However, if we fall lower, then the 1968-1970 mark on the E-minis comes into play again. It still remains within this channel. These channels have been drawn specifically so people can visually interact with them. My members can. I do not like drawing uber complicated charts which no one understands and they don't know what the heck's going on. So let me clear the lines here and explain it in simple terms. Channels and the markets basically moving in between the channels, correct? So bottom line is that so we are moving like this. So upper end of this channel is up here. Once it hits the upper end of the channel, is it possible that it comes down and tests this and then breaks up towards the second channel, which is 2020? translates into about 2027, somewhere around there on the S&P 500? Absolutely. Okay, but let's leave it at that for now. So bottom line is that lower end of the channel, again, is 1970. Now, why are these important? I repeat, especially for new members. These critical levels are important because it doesn't matter what trades you do. If you do not understand where the E-minis or the S&Ps are trading at, you will not make money, or you will give up all your profits or make stupid losing trades, period. People who have been with me for a while know that very well. In the meantime, we also trade S&P futures, S&P options, long and short intraday, which are hugely profitable. Hugely profitable. Many times. Frustrating days like yesterday even got us a chance to basically get out at very nice 60-70%, if not higher returns, if, as I have always said, you know how to dollar cost average down. Okay, if you do not dollar cost average down on volatility, in my opinion, you are not going to make some real money. Buying this S&P call or put right at the onset and making 2 or 3 points is possible, but those are low probability trades. Generally, what happens is we buy, and then let's say we buy an S&P call at 8, okay? S&P call at 8. These are very fast-moving creatures, okay? They move like futures. All of a sudden, they'll be down to 6. For no other reason than the S&P probably fell about 4 points because of market volatility. That's within 10 minutes, mind you, all right? So these are for fast traders, but this is where real good money can be made. You don't even have to play that much. I mean, larger amounts. Play with smaller amounts. You know, that's my suggestion. So it drops, and it drops 2 points fast. So you're like, whoa. Then it drops another point. At that point, it's 5. So what do? Do you scream and say, oh my God, it's over? No. In my opinion, it's what I do. I'll buy at 5. I'll buy a bunch at 5. Now the cost is 13, so my average cost now has come down to 6.5. Within 10-15 minutes, the market hits this lower end of the channel, just give you an example, and then ramps up. I show this all the time. I don't make this up. That's what volatility does. All of a sudden, these babies are at 10. My profit, 3.5. Roughly about 50% on the money. Okay? Roughly about 50% on the money. And this is all within, let's say, a space of half an hour to 35 minutes. Sometimes longer. Bottom line is that dollar cost averaging both on the calls and the puts, mind you, are equally critical. On the put side, I dollar cost average. My dollar cost average had come down to close to, I believe, 7 or something yesterday. So when they ramped up and went to 13, Lordy, that was a gift. So that's the way it goes. Even at the close, they were around 10, right? But if I hadn't dollar cost average down, I would be stuck at that 8 range. And, well, not for yesterday, I'm just saying in general, I'd be stuck at the higher price. And yes, they would eventually go to 10, but the chances are that if I got stopped out at 5, and I didn't dollar cost average down, I would be looking like a royal idiot, and I would feel like a royal idiot, and then, you know what? My confidence would be lost. So dollar cost averaging, in my opinion, on volatile instruments, mind you, cost averaging, on volatile instruments, especially when you're playing S&P calls and puts, and indices primarily, are very, very important. On the stock side, it's a mixed bag. Sometimes stocks break down and they stay below there, and obviously cost averaging won't do anything for you. Okay, that's it for now. Thank you for listening. Have a great trading day, and thank you for being part of the Clueless 8 service.